Okay, so if you're following the economic news right now, it feels like the market is shouting two completely different things at us, doesn't it?
It really does. You've got these tech giants, think Amazon, hitting all-time stock highs, mostly because of this enormous, like unprecedented spending on AI.
Right. But then, the other side of the coin, you see these massive job cuts. We're talking over 60,000 this year from big names. And, well, the whole economic picture is murky because of this government shutdown that just won't end.
Exactly. And that tension, that friction, that's really what we're diving into today based on the sources we've gathered. Our mission here is to try and make sense of an economy that seems to be in a really rapid, almost, well, schizophrenic transition.
Schizophrenic is a good word for it.
Yeah, we're going to unpack how this tech disruption is hitting the workforce, why investors seem obsessed with AI growth over maybe current profits, and how these, significant political headwinds are creating this weird data vacuum.
Which is ironically making markets even jumpier.
Precisely. It's driving volatility in currencies, in stocks. So we'll be looking at everything from, say, BP's earnings to the very specific valuation issues facing a company like Palantir.
Okay, let's start with maybe the most jarring piece.
Yeah.
The job market disconnect.
Hmm.
I mean, when you see names like Amazon, UPS, Target announcing cuts totaling over 60,000 jobs, it sets off alarm bells.
Uh-huh.
Is this it? Is this the AI-driven white-collar recession people have been worried about finally kicking off? Or is there something else at play?
Well, the sources suggest it's more the latter, but maybe dressed up as the former. This is where we bump into this concept of AI washing.
AI washing. Okay.
Yeah. While AI definitely is making some things more efficient, and we can talk about specific examples, a lot of experts, like Peter Capelli over at Wharton, they argue that the bulk of these really big layoff numbers, they're driven by older reasons.
Like what?
Things like, realizing they overhired during the pandemic boom, getting nervous about consumers maybe spending less, and just good old-fashioned cost cutting.
So companies might be using AI as kind of a convenient explanation, like a buzzword to justify cuts, maybe driven by slowing sales because they know investors like to hear about efficiency gains.
That's exactly the theory. Cutting staff often gets an immediate thumbs up from Wall Street. It signals discipline, right? And that can create this bandwagon effect.
So if one major player cuts, others feel the pressure to do the same, even if their own AI strategy isn't the main driver.
Pretty much. And if you look closely at the reasons companies give, they're actually quite different.
Can you give us a couple of examples of how those reasons differ?
Sure. Take UPS. They cut, 34,000 operational jobs. But that was largely tied to closing 93 physical buildings. They needed to streamline their logistics network. That's really a business model shift, a response to volume changes, not, robots suddenly replacing everyone overnight.
Okay, so that's operational streamlining. What about Amazon or Target?
Similar story there, citing streamlining, adjusting to maybe lower consumer demand patterns post-pandemic. But then you do have companies being very explicit about tech shifts.
Right.
Klarna, the fintech firm, they cut their headcount by 40%, and they partly pointed to AI integration. Duolingo, the language app, they're openly replacing human contractors with AI for certain tasks.
That's Salesforce too, wasn't it?
Yes, Salesforce was very direct. They said AI can now handle about half of the work done by the 4,000 customer support roles they cut. And IBM is also doing some trimming, maybe around 2,700 jobs globally this quarter, again, framed as part of an efficiency drive.
So it's a mix. But the sources also suggest that even if it's not all AI yet, the overall labor market is clearly getting softer. And the government shutdown makes it hard to get the official numbers right. So we're relying on other indicators.
That's a huge problem, the data vacuum. We have to look at things like Indeed's job postings index. That just hit its lowest point since way back in February 2021.
Whoa.
That tells you companies are just not looking to hire as aggressively. And maybe even more telling, we're seeing salaries offered in those job postings come down. Year-over-year wage growth in postings fell from 3.4% back in January to just 2.5% in August.
So fewer openings
Yeah.
and less pay being offered for the ones that are open. The belt is definitely tightening.
Faster than maybe people realize, yeah. Okay, now let's try and connect those layoffs to the other side of the story, the companies driving those record stock market highs, the tech sector. And Amazon really is the perfect example of this whole contradictory dynamic.
How so?
Well, look, they've cut, 41,000 corporate jobs since 2022? A huge number. But at the same time, they are pouring absolutely massive amounts of money into AI infrastructure. Their capital expenditure budget this year is expected to hit something like $125 billion.
$125 billion. That's just Hard to comprehend. And that commitment, that spending on infrastructure, that's what the market loves right now.
Yeah.
I mean, Amazon hit a record high right after that massive cloud deal with OpenAI was reported, right? $38 billion.
Exactly. Investors are sending a clear signal. We care more about you winning the future AI race than we care about your current headcount numbers. It's a bet on future dominance.
And speaking of OpenAI, they're not just doing big infrastructure deals. They just launched their Sora video generation app on Android in a few countries, after it was apparently a huge hit on iOS.
Right, so they're pushing on the consumer front too.
No.
It's like a two-pronged attack. Solidify the consumer AI tools while battling Amazon and others on the underlying cloud infrastructure side. But, this kind of high-stakes environment, it brings intense scrutiny, which leads us neatly into the valuation game, and specifically Palantir.
Palantir. Yeah, that was interesting. They actually beat their earnings estimates, raised their guidance for the future, and the stock still dropped 8%. What happened there?
Simple answer. Valuation, just sheer valuation. Their forward price-to-earnings ratio, the PE ratio, was sitting at 254.
254. Just for context, what's it like NVIDIA's?
NVIDIA, which is obviously the superstar of AI chips right now, is trading around a PE of 35. So 254, that implies investors expect absolute perfection, flawless growth for years, maybe decades, to justify that price.
So when the stock drops even after a beat, the market's not saying the company did poorly. It's saying we're still nervous about whether anyone can live up to this incredibly high expectation.
Precisely. It's pricing in the risk of that high bar. I know their CEO, Alex Karp, he called the short sellers' actions market manipulation.
I remember that quote.
Yeah, but you could argue the market is just reacting, maybe logically, to an extreme valuation,
Gotcha. And this intense competition, it's starting to create other kinds of friction too, right? Like actual conflicts between companies.
Absolutely. Look at the fight brewing between Amazon and this AI company, Perplexity AI.
What's that about?
Perplexity developed an AI browser called Comet. And what it does, essentially, is let you ask the AI assistant to make purchases for you on Amazon, kind of bypassing Amazon's usual website interface.
Oh, okay. So Perplexity is trying to insert itself between the customer and Amazon, controlling the point where you actually buy something. I can see why Amazon wouldn't like that.
Exactly. Amazon called it evading the company and said it degrades the shopping experience, presumably by skipping all their personalized ads and recommendations.
Right.
Perplexity fired back, calling Amazon's legal threats bullying. But really, it's a fundamental fight over who owns the customer interface, who controls that interaction in this emerging AI world. The stakes are huge.
Wow. Okay, before we shift gears to the broader economy, there was one more tech-related piece that really jumped out at me, the energy angle for all this AI, the Saudi Aramco stuff.
Oh, yeah, that's a huge long-term play, and the number is just mind-blowing.
Tell us about it.
So Saudi Aramco is positioning itself to be a major global player in building and powering AI data centers. They plan to use their, cheap supplies of natural gas and also their growing renewable energy capacity.
Okay, that makes sense, leveraging their energy resources. But what was the figure?
Their CEO pointed out that by 2030, these AI data centers, the engines powering this whole revolution, are projected to consume almost 4 times the amount of electricity as the entire global fleet of electric vehicles.
4 times the global EV fleet. Seriously. We spend so much time talking about the grid upgrades needed for EVs. But this suggests the real massive energy demand shift we need to watch is the one powering AI. That completely reframes the conversation about future energy needs, doesn't it?
It really does. It's a massive, under-discussed consequence of the AI boom.
Okay, so that massive energy demand ties back into the traditional economy, where, as we said, a lot of sectors are facing headwinds from the macro climate, fighting their own specific battles. Let's start with energy itself. BP just announced a pretty decent third-quarter profit beat, right? $2.21 billion.
Yeah, they did. And it was interesting how they did it. It was driven mostly by higher production of good old crude oil and natural gas. This came after they had previously made a big strategic push towards prioritizing renewables.
So they pivoted back to fossil fuels, or at least leaned into them more.
Seems like it, yeah. And that timing worked out well for them because while overall oil prices have been a bit weaker lately, worries about global oversupply, weak manufacturing data, the strong dollar hurting demand BP managed to boost its output and efficiency, so they kind of bucked the trend of softer prices and delivered that profit beat.
Okay, so some resilience there in traditional energy. But contract that with the electric vehicle sector. That seems to be going through a really tough patch, like a hangover after the crazy growth years. Companies like Rivian and Lucid look like they're struggling.
They're definitely getting hit from multiple sides. Domestically, a big factor is the loss of that $7,500 federal tax credit for many models.
Hmm.
A lot of analysts think Q3 was probably the peak for EV sales for a while, basically because customers rushed to buy before that incentive went away.
Pulling demand for it.
Exactly. And then you've got external stuff like trade tariffs. Rivian mentioned tariffs are adding like a couple $1,000s per unit to their costs. Yeah. And both companies are still losing significant amounts of money on each vehicle. They're really banking on future, hopefully more profitable products to turn things around, like Rivian's upcoming R2, which is aimed at a lower price point, around $45,000, and Lucid's Gravity SUV.
So a tough road ahead for the EV startups. And what about commercial real estate, CRE? The sources said overall deal volume growth is pretty slow, only up 5% through Q3. But it sounds like a very uneven picture within the sector.
Very uneven. It's really like a two-speed market. On the slow track, you have the hotel sector. Deal value there is down a whopping 30%.
30%. Why so bad?
Just basic economic uncertainty. Companies are cautious about spending, which means less business travel. That hits hotels hard. So hotels are a clear loser right now.
Okay. But there are winners.
Yes, the winners are all about what they call a flight to quality. Investors are pouring money into the perceived best, safest properties. Deals for properties valued over $100 million, those are actually up 35%.
So the big money is chasing only the prime assets.
Exactly. And what's really fascinating is who is doing some of the buying, especially in the office space. You have these cash flush tech companies like Apple, like NVIDIA, actually snapping up office buildings.
Really, buying office buildings when everyone's worried about remote work.
Yeah, but they're often getting them at steep discounts. There was one MetLife deal mentioned where the property sold for something like a 39% discount off a previous valuation. These tech giants seem to view it as a chance to pick up prime real estate cheap for the long term.
Interesting strategic play. Any other bright spots?
Open-air retail, like shopping centers, is also doing okay. It's seen as more resilient, providing essential services, and less vulnerable than maybe enclosed malls or office buildings. And underlying all of this, we absolutely have to talk about the political situation because it's casting a long shadow, particularly this government shutdown. It just hit day 36, making it the longest in U.S. history. And there's still no funding bill passed by the Senate.
Still stuck. And the core disagreement is still the same, right? Republicans want what they call a clean stopgap, just temporary funding, no extra policy stuff. But Democrats are digging in, saying no deal unless it includes funding for the enhanced ACA tax credits.
That's the logjam. And this political fight has very real, very immediate consequences, especially this growing crisis around SNAP benefits.
Yeah, the food stamp program. That sounds serious.
It is. It directly connects the political dysfunction to potential consumer spending shocks. Initially, President Trump suggested that no SNAP benefits would go out during the shutdown. Later, his administration filed in court saying they could pay about half the costs using a contingency fund. But that still leaves huge uncertainty for the 42 million Americans who rely on the program.
And if those benefits were seriously disrupted?
That would be an instant, massive blow to consumer spending across the country, a huge risk hanging out there.
And this shutdown, besides the direct impacts like SNAP, is also messing with market expectations because we're not getting the usual economic data, right, like the official jobs report.
Exactly. That lack of official data, combined with what seems like a divided Federal Reserve unsure about its next move, it's just breeding uncertainty. You saw it in the odds for a December rate cut. Just a week ago, traders saw it as almost certain, like 94% probability. Now, it's down to around 65%.
So much less certainty about Fed action.
And that confusion triggered a classic risk-off move in the markets. When data is unreliable and politics are unstable, investors tend to run for cover.
Where does they run?
The U.S. dollar. It climbed to a 4-month high against the euro. It's that sort of old-fashioned haven bid. In times of doubt, the dollar is still seen as the safest place to park money.
Okay, so dollar up. And that risk-off feeling hit other areas too, like crypto.
Oh, yeah. Bitcoin actually dipped below $100,000 for the first time since late June. It was trading as low as $99,966 briefly. It really shows how linked crypto sentiment has become to the appetite for risk in those high-flying AI stocks we talked about, like Palantir. When risk appetite fades, both tend to suffer.
Interesting parallel. And just quickly, any update on the crypto legal front? The Sam Bankman-Fried appeal.
Yeah, the hearing happened. Reports suggest the judges were pretty skeptical about his challenge to the fraud conviction. This was despite his defense team making this kind of bold claim that 98% of FTX creditors have actually gotten back 120% of what they were owed, plus interest.
Wow, 120% back. That's surprising. But it sounds like the conviction itself is likely to stand.
Seems that way, yeah. The financial recovery for creditors doesn't necessarily undo the underlying fraud finding.
Gotcha. And just touching briefly on other political news, mentioned tight governor's race in New Jersey and the New York City mayoral election looking interesting, with Zohran Mamdani leading the Democratic Socialist ticket against Andrew Cuomo running as an independent, and the Republican Curtis Sliwa. Just noting those are happening amidst all this other turmoil.
Right. Lots of moving pieces politically. Hashtag tag outro. So if we try to pull this all together, synthesize this deep dive for you, what picture emerges? I think it's really one of a two-speed economy, maybe even operating in two different dimensions simultaneously.
How do you mean?
Well, you have the market, which is overwhelmingly rewarding growth and technology investment. Those AI megacaps, the Amazons of the world, they're hitting records. They're thriving based on future promise.
Okay, dimension one, high growth, high risk tech.
Right. But that growth is happening almost in its own silo. Meanwhile, dimension two, the traditional economy consumer spending reflected in retail. Logistics like UPS, old economy jobs, much of the physical real estate market, that part is flashing warning signs. Mass layoffs, falling job openings, cautious behavior.
So a clear split. Speed and efficiency are being prized above all else in one part, maybe at the expense of stability or traditional labor strength in the other.
That's the dynamic. Which brings us, I think, to our final provocative thought for you, the listener, to chew on.
Okay, let's hear it.
If companies keep using AI strategically as the public reason for these large-scale layoffs, and if investors keep rewarding that cost-cutting behavior so readily, even when the overall market is hitting highs, could this dynamic actually permanently break that historical link we've always assumed exists between strong corporate performance and a healthy, broad labor market? Is that connection fraying for good?